Folks, here we go with another exciting earnings. This is the retail week of earnings we've been waiting for, okay? We're starting off with none other than, well, the biggest brick-and-mortar retailer out there, Walmart. As you can see, the stock is down so far today, opening up down. From my earnings video earlier this week, you may have noticed that I kind of expected the EPS line. Can't really expect it, right? The EPS line was something that is a little bit of a crapshoot on this company, just due to all of the increased factors right now you have to consider in terms of cost of goods and really different inflationary impacts. So due to the supply chain constraints, we're seeing issues with the EPS line. But because of that, we see a benefit in terms of revenue potential. So that is where I would expect a beat on that aspect. And let's look at these earnings and see what we can find. So a quarter 3 non-GAAP EPS of $1.45 is a beat by 6 cents, but on a GAAP standpoint, $1.11 missed by 29. So that's where you see that kind of a crapshoot, in my opinion. It's hard to say. But what is wild here is this revenue line. This was a company expected to grow really less than 0.5% year over year. They grew 4.3% over an incredible year last year. There was a high single-digit rise, beat by $6 billion, $140.5 billion, beat by $6 billion. This is not the kind of beat you see from Walmart. This isn't. This stock was already trading incredibly cheap, and now it's trading even cheaper somehow. I don't know how this is possible. But we're talking about a very, very cheap price to sales on this stock. It's almost criminally undervalued. I don't know, criminally undervalued. It really is. I mean, even with the great starting yield now of 1.5%. I mean, this is a good pickup. My gosh. E-commerce sales grew 8% for the quarter and 87% on a 2-year stack. Fantastic. Obviously, it's hard to grow year over year, but they still grew year over year in e-commerce after last year just absolutely skyrocketed to a over 100% year over year growth for them. So to see still 87% 2-year stack, which is more fair to do a 2-year stack compared to 2019 numbers than it is to 2020 because of it being such a crazy year, and these numbers are up massively from 2019 still. So that's what you got to consider. And this stock hasn't moved. It hasn't moved. It's crazy. They expect comp sales in Q4 to be around 5%, which would be quite incredible. For the full year, they're expecting to be comp sales. Look, someone forgot to hit the space bar. I get it. We aren't good here. Do I have to do a little inspect element maybe and maybe adjust that? I don't know. Sometimes you feel like you have to, and they really do this for you. Oh, wow. Paywall full cut. Okay. I could adjust this if I wanted to. I guess I don't need to. Look, that's too much effort, boys. So this is exciting stuff, even though they didn't type it right. But expect comp sales to be around 6% growth for the year. Excluding fuel, obviously. GAAP EPS around $5, and adjusted EPS around $6.40 versus the prior guidance of $6.20 to $6.35. So that's going up too, and consensus was $6.32. So even better in terms of that aspect too. Raise of guidance, yet still the stock's down. What's going on here? I don't know what you can do if you're a Walmart stock at this point. Why are you down at this point? I don't get it. Just the stock gets no nods. Let's look at some of the great stuff. Comp sales increased 9.2 in the quarter, 15.6% on the 2-year stack again. That's what I'm talking about. It's incredible growth when you're talking about 2019 numbers. It's incredible. Transactions up 5.7% as well. Obviously, big points are going to be transactions as well as cart size, because if they're able to increase average ticket and transactions, it's a pretty good number for them. The company expects Q4 comp sales around 5%, which is good. And Walmart U.S. inventory is expected to be up 11.5% ahead of holidays, planning for these incredibly big sales moments. And if you happen to be knowledgeable about the retail industry at all, this is going to be a very interesting year compared to last year. We still saw big supply constraints last year in terms of really even Christmas shopping. Now this year, people are buying very much ahead of time. We're seeing incredible Christmas shopping being done already. This is why companies are already doing Black Friday deals. They're doing it at the start of November because people are buying early. They're buying really early. And if that momentum continues into December, this could be the biggest breakout quarter of all time if they're able to just continue massive growth. But we'll see what it looks like. Again, raised full year guidance. Don't know why we're upset about that. I don't really know. I don't really know about that. Revenue was negatively affected by $9.4 billion related to divestitures, so this could be an even bigger number. Wild stuff. I don't know what else you want to see. Sam's Club comp sales increased 13.9. That business continues to be massive, 25% on a 2-year stack. E-commerce grew 32%. Obviously, a very small, much smaller business for the Sam's Club side of it than it is the Walmart side. The website isn't that flushed out. So what do you expect? Membership income grew 11.5. Fifth consecutive quarter of double-digit growth, which is massive for them. If you're not aware of the Sam's Club side there, think of it, it's basically a Costco. It's the same exact aspect. They sell products at very low margin, but that membership line is 100% profit if you think about it. You're literally having people pay just to come in. So that 100% profit line, the more they can grow that, the better it is, obviously, for the company because it's pure profit. So you want to increase that membership income. You absolutely do. International sales decreased $5.9 billion. That's pretty wild. Negatively affected by $9.4 billion in divestitures. So that's where that kicks in. Yeah, that's where that comes into play, I guess. So that would be why they're down in that aspect. So nothing else crazy. Profit rate decreased 42 basis points. Increased supply chain costs, as I mentioned. Look, we already know this. They repurchased $7.4 billion in shares year to date so far, which is only 35% of the $20 billion authorization announced earlier this year. So they've got a lot more share buybacks to be had. It's a great. I don't know. The stock looks just good right now. Maybe I can find something that differs from that. I don't know. But to me, it looks good right now. Operating income, slight rise, 0.2% year over year. Nothing crazy by any means. Nothing crazy. So by segment, obviously, we like looking at that. We look at net sales. What's good about net sales? Well, what's good about net sales is on the Walmart side, fantastic, 9.3% growth in net sales. Average ticket still grew. That's right. Still grew. Average ticket growing, transactions growing, which is good for every aspect of the business. It really is. International, we saw terrible numbers, just terrible numbers. No doubt about it. The Sam's Club side of it, they grew average ticket, or transactions and average ticket, and e-commerce contribution. Anyone else hear noises? I hear noises. So good to see in that aspect. So what else can we look at? Well, obviously we look at the balance sheet. It's one thing we like to look at. Let's look at this net income line. Basic net income here. Oh, look at this. Look at these. Look at the decline there. That's okay. That's okay. We're okay with this line. We really are. Yeah. It's good to see. I don't know. I like all these numbers. We'll look at the balance sheet in just 1 second. Free cash flow numbers. You can see 9 months ending definitely declined pretty massively year over year. So could that be part of it? I don't know. We'll look at the balance sheet and see if it's really impacted by a negative. Not really a negative number in the cash flow. It's still $7 million. I'll take it all day. But let's see. So we're going to do the year-over-year comparison. I know 9 months is usually pretty great, but I like the year-over-year. If they're offering the year-over-year, I'm going to take it. Total current assets has risen in the last year, 82.9 compared to 73.6. So current assets growing mostly here in the inventories category, which is obviously important coming into Q4. Total assets in general did fall though, 244.8 compared to 250. 0.8. So $6 billion decline there. I'm curious if they paid off some debt potentially. Let's take a look at it. Short term current liabilities at 87.6 compared to 88.1. So slight decline there. Of around $500 million, which is definitely a big decline for me. But this long-term debt line, you can see, did decline as well. It was at $40.8 billion. They've decreased down to 36.4. So that's, positive news for them. Shareholder equity has risen in the last year, now at 90.7 compared to 87.5. It's a really good balance sheet. I like it a lot. And if you look at the stock, the stock's trading at a $400 billion market cap, under $400 billion if you account for today. It's under $400 billion. And this company in one quarter brought in $140 billion. This is a company that's bringing in this year $550 billion in revenue, yet they're trading at a market cap under $400 billion. This is an incredibly cheap company that's still showing, despite a massive last year, they're still growing. They're still growing revenue lines. And again, when you consider the aspects of Walmart Plus, which they didn't mention really at all here, as a big key here, which I think could be a massive aspect for them. I think if they sell Walmart Plus more than they are right now as a company, sell it really to Wall Street, I think that it's a lot better for this company if they were to do something like that. Because, look, subscription services are what gets Wall Street going right now. Well, now technically it's metaverse platforms. I don't know, metaverse is the new big thing, but Walmart just needs to talk about having a metaverse, and they're in. Look, this stock's a buy. That's what I got for you.